Hi, and welcome back to the LLQP video series. Once again, this is Jason Watt of Business Career College, and what we're going to be looking at today is the temporary insurance agreement. Now, this is really a part of the application process. So normally, within the application or attached to the application somewhere, you will see a TIA, or sometimes we call this a conditional insurance agreement, a CIA. Both really mean the same thing. And the issue here is that the underwriting process can take some time. So the underwriting process might take a few weeks or a few months. It's not uncommon to take, say, 2 to 3 months for an application to get from underwriting to the point where a policy is ready to be issued. And the problem with that, of course, is that we've maybe put this idea in our client's head now that they really need this insurance, and they don't want to be without coverage now for this amount of time. So what we can do as the agent is we can put in place an amount of insurance, this TIA or CIA. Now what will happen is this insurance will be enforced typically for a limited amount of time. So it's not perpetual. It's very common to see this run out after, say, 90 days. That's not always the case. It's not universal, but that's pretty normal. And it will typically also be for a limited amount of insurance. Again, very common, but not always the case that you would see a maximum of, let's say, $1 million of coverage under a TIA. So during this time that the TIA is in force, this person would be covered for $1 million, 90 days of coverage, pretty typical. And the other thing we're going to have to do is we're going to have to collect the first premium. We'll talk more about this requirement to collect the first premium when we talk a little bit about contract law in a later video, but for now it's important to recognize that we do need to have that first premium collected. There are typically no other premiums paid while the TIA is outstanding. Just that first month's premium would be paid. Now, you're not going to issue a TIA if we have significant concerns in the underwriting process. So if you go through the application with the client and the client is awaiting results of medical exams, or they're getting ready to leave the country, or they've recently had some sort of problem medically, you're not going to issue any sort of TIA. This is you, the agent, making the decision to bind. You have to do some underwriting here. You have to make the decision whether or not this is appropriate to issue the TIA. And then what will happen is we have this TIA in force. So if there is a covered loss during the time when the TIA is in force, a claim should be paid. Now, something that has to happen is we do have to finish the underwriting process. So we must finish underwriting in order to facilitate the payment of a claim. And the reason for that is because we want to make sure the client was honest in the application. If they lied in the application and we shouldn't have issued a TIA, then it doesn't make any sense to pay that claim either. And it's not even necessarily the case that the loss in question has to be related to the issue that the client lied about. It does have to be material, but if the client saw fit to lie about their smoking status, for example, then who knows what else they might have lied about. So we are going to finish the underwriting process before any claim that comes up in the TIA would be paid. If there's a concern there, then that's enough. We would say no, that we're not going to issue that policy, and that would end the TIA, which leads us to our next point, is how long does the TIA last for? Well, we already said it might last for some sort of predetermined amount of time, such as 90 days. So there might be a built-in expiry here. That's very normal. The other thing that we'll see is that the TIA will run out when there is a decision made. So when we have a decision to either issue a policy or a decision to decline When either one of those things happen, that ends the TIA as well. So on the day, basically the minute that the underwriter says, I'm not going to issue coverage, they stamp that thing declined, and at that point immediately an email is sent saying, I've just made the decision to decline coverage. Any TIA in force is no longer in force. And once the underwriter makes the decision to issue, we don't want to have two coverages in force. So once the underwriter says, yes, we're going to issue a policy, now that policy would be arguably, but most likely for the purpose of insurance law, that policy would be enforced from that point. So we would cancel the TIA at that point. So that covers the temporary insurance agreement. It's a fairly regular thing to see one or two exam questions on the TIA, and it's something you'll probably deal with pretty much every time that you sell a life insurance or other sort of insurance policies. TIAs are not just for life insurance. You can have them for disability insurance and critical illness insurance as well. Thanks very much. I hope this helps you to understand the temporary insurance agreement.